Hello again. Today, I have a couple of topics to discuss with you, and after that, we'll move into the background for our very first option strategy, something that actually is tradable. I'm saying it now, I'm going to say it again. You won't be ready to make this trade yet. There's a lot I want to explain to you because this is our very first strategy. I want to give you a lot of details, a lot of background, a lot of repetition, a lot of detail. That's the emphasis, so that you understand what you're doing, that you understand how this trade works. But before we get to that, 2 items of background information. 1, you have to be used to and know how to use your broker's trading platform. It's too easy to make a mistake, buy instead of sell, or do a call instead of a put. These days, most brokers have very sophisticated electronic platforms that are easy to use and essentially error-proof. But I remember when I started, it was too easy to get it wrong. I only did it once, but I don't want you to do it. So practice in their paper trading account. Just make some buys, make some sells. You don't have to look for anything strategic to make money, but just make sure you know how to enter an order. And don't take anything for granted. One type of spread that I'm going to be talking about down the road is an iron condor. And to make exactly the same trade, some brokers refer to it as buy it, some brokers refer to it as sell, and it's exactly the same trade. So don't assume when you say buy or sell that you know what it means. For a simple option, a buy or sell, it's clear. But when you enter more complex orders, and you will, like spreads, I just want you to be certain you know how to use your broker's platform. That's just a warning, a word to the wise. When you open an account with your broker, they're going to make you fill out an application and decide if options are appropriate for you. So give them your background, tell them your trading experience, tell them what you want to do, tell them that you want to have income and that you don't want to speculate. Those are the keys, I think, to getting yourself approved without any problem. When you open the account, they're going to want you to download an electronic pamphlet. Characteristics and risks of standardized options. This has useful information, and you will want to read at least parts of it. I would not just skim it and toss it away. I mean, keep it around and give it a look at. It's worthwhile. You'll find many things in there that are useful. Some you can just skip over. I'll trust you to figure out what's what. Next, you have to have a certain minimum balance to open your brokerage account. Each broker has its own suggested minimum, but let me tell you, when you're trading options, $2,000 or $3,000 really is not good. It's much better to have 10 or 20. So we're going to try to produce strategies that you can trade with smaller account values, but I don't want you to start gambling with the thought that, well, I don't have much money. There isn't much here, and I can only risk $300 on this trade. What's the big deal? Don't think of it as what's the big deal. The $3,000 will be $3,000 or $30,000 in years to come. So treat your money with respect, and it will respect you in return. Which brings me to the second point I want to discuss, risk management. Now, this is not something I can show you in a small amount of time, but this is a mindset. My mindset is that managing risk and preventing large losses is the single most important factor that determines how successful you will be when trading options and in reality when trading anything else. Most people only look at profit and loss. I have a spread on. I have to make a profit. I can't take it off for a loss. I have to manipulate it, change it, fix it, adjust it. I have to do something to prevent the loss. That's a very bad mindset. The mindset should be, I have this position. It's not working well, but I can do this to make it safer. But that's the key. Safer, less risk, avoiding the big risk. That's far more important than making sure it's a profit. If you lock in a loss or have to close it for a loss, that's fine. There's nothing wrong with that. Put on a better position, a new position. Why struggle with a loser that's giving you trouble when you can take it off your sheets? That means just get it out of your account by closing and opening up a newer position. It's safer, higher probability of success, easier to handle, and you'll be in a better mental state because nobody likes to manage a losing or difficult to manage position. So I'm always going to be talking to you about managing risk and trying to minimize losses. My theory is the profits take care of themselves, and as long as you're making money, everything is fine. Your job as a risk manager, you have two jobs. You're a risk manager and a trader. Your job as a risk manager is to keep the trader in line and make sure that he or she recognizes when risk is getting too high. And of course, I'll help you understand when that level is, but I can't define it for you exactly. Your comfort zone, your tolerance for risk, your investment objectives, even your age, or whether you're near retirement or first starting a career and starting to earn money, all affect how you're going to trade. So I can't define your comfort zone. I can't define your risk tolerance for you, but I can help you find it. And that's important. So risk management is going to be an ever-recurring theme throughout this course. The first strategy that we want to talk about is covered call writing. I choose this strategy because it's easy to learn, and for traders like yourselves, if you have traded stocks before coming into the options world, then you already know half the business of writing covered calls, and that makes it more familiar to you, more comfortable, and easier to get into. And if you have not traded at all, then this is a relatively elementary way to begin trading. Covered call writing is a term that's used to describe a position that has two parts. Those are referred to as two legs. The first part is owning stock in increments of 100 shares. I probably won't bother to mention that again, but when we trade options, each option represents 100 shares of stock, and therefore, if you're going to be working with stock, you want to have 100 shares of stock, or 200 or 500 or some multiple. So it requires buying or owning 100 shares of stock and selling one call option. That call option grants someone else the right to buy your stock at a specified price, a strike price, for a limited period of time until the option expires. So you would be selling a call option. Now, the term is called writing covered calls because when you sell an option that you do not own, what you're doing is you're opening or writing a brand new contract, one that did not exist before. You're writing it and someone's buying it. So the term write simply means sell. Some people use the term writing, some people use the term selling. Covered call writing is the generally accepted terminology. Now, we're talking about covered in the title, covered call writing. What does covered mean? When you sell a call option, you accept an obligation in which you may be required to sell 100 shares of stock. 100 shares for each call option. That's part of the contract. If you already own the shares, then you are covered. Because if you are assigned an exercise notice, you can just hand over the shares. You already have them. They're already in your account. You're covered. If you don't own the shares, or if you don't own enough shares, if you sell 2 calls and only have 100 shares or 150 shares, you can't deliver all 200 calls. If you can't do that, if you're not covered, then you're uncovered. And the term that we use in the options world is naked. Naked short. Naked short is you sold a position for which you're uncovered. So if you don't own the stock, you're selling a naked call. Most brokers consider that to be a very risky strategy. The reason is simple. When you sell a naked call, you have to deliver shares. And the stock could run way, way, way higher. And at some point in time, you're going to have to buy it. In theory, the stock can go to infinity. Of course, in practice, nothing like of the sort ever happens. But because you can take a large loss, brokers only allow the most experienced customers to trade naked call options, naked short call options, and it's not something that I recommend anyway. But I want you to understand why some brokers don't allow it. So if you want to write covered calls, you should be in fine shape. That's a very elementary strategy, and writing covered calls is something that you can do. For those of you who are interested, there's such a thing as covered puts. You sell stock and you sell a put. I'm not going to be talking about that, but it's easy enough to reference it somewhere. If you really want to, just check it out on the internet. And by the way, any of these topics that we're discussing, my book, The Rookie's Guide to Options, is clearly the one that I recommend. And if you don't have it, feel free to get a copy and follow along, because some of this book is covered in these slides, and most of it isn't. But there are other beginner books, and you don't have to use this one. It's just that's the one that I use, and of course, I like it. So, writing covered calls. In describing it, it's much easier if you have visuals. So I'm going to stop this portion of the tape and go to PowerPoint slides where I can put material on the screen that you can see and digest much more easily. We're going to learn to be writing covered calls, and it's not going to be finished in today's film. It's going to take several lessons for us to get into the details, because I really want you to get it right. See you shortly.
Getting started writing covered calls. We're here to talk about options. This is an options class. However, for this specific strategy, covered call writing, options play a secondary role. When it comes to determining your eventual profit and loss, it depends on the stock you pick. Stock selection is of primary importance. And the reason for that is if the stock takes a big dive, 10, 20, 30%, the options won't save you. They'll reduce your losses, they'll make it a little bit less uncomfortable, but the profit and loss picture depends on the performance of your stock. So please don't choose stocks randomly. Choose stocks that you want to own, choose stocks that you've researched. However it is you do it, I'm not here to tell you how to do that. I frankly don't know how to do that. I don't trade stocks. I'm not a good stock picker. But you have to have a method. And if you don't have a method, then that's fine. You can use index options instead, or exchange traded funds instead. Those are, if you're not familiar with those are similar to mutual funds that trade on the stock exchange. But those ETFs make good diversified portfolios if you don't want to pick your own stocks. Now, you don't have to own the big winners. When buying stocks, it's traditional to look for things that are going to double or at least make 20, 30% a year. You're looking for something that you think is undervalued that has a chance to go up big. Now, that's fine for writing covered calls, but it's not necessary. The name of the game here is to pick a stock that's going to go up at all. It doesn't really matter how much, just some is good. And you have to avoid the stocks that take the big tumbles. That's the success with covered call writing. Now, there's more to the strategy and picking the right options, and we'll get into that. But if you pick a bad stock, there's not much that the options can do to help. What's nice about this strategy, and what was attractive to me years ago, is that the stock can go down and you can still have a profit. That's pretty neat. This is a bullish strategy. It makes money when your stocks go up, but you can actually have a stock decline and come out with a profit. That's good. That feels good. The path to success for making money when writing covered calls is that it happens most of the time naturally. The path is right there. If the stock rallies, you'll make money. If the market is steady and your stock doesn't go anywhere in price change, you'll make a profit. If the price decline is small, and by small I'm defining that as less than you collect in premium when you sell your covered call. Remember, when you sell, the buyer pays a premium to the seller and you get to keep that cash. But you lose possibly a large loss when the stock tumbles. So the point is, you make money in up markets, steady markets, slightly down markets. You only lose in the big down markets, and so that means you make money most of the time with this strategy. You'll make money more often than you do when buying stocks, but to compensate for that, your profits are going to be limited. So the strategy wins more often, but there's no gigantic wins. So how does covered call writing work? First, you either own or buy 100 shares or some multiple of that of a stock you want to own. You have to have the mindset that allows you to accept a limit or a cap on potential profits. Now you're going to get paid a premium to limit those profits, but you still have to be willing to limit them. And the objective here is to make money trade after trade after trade. You can spend it or compound it, but that's how you get steady growth. The investment objective is not to find the next stock that just keeps doubling. Covered call writing is not for everyone. It depends a lot on your investment objectives. For example, very, very conservative investors won't like this strategy because there's still some downside risk. But if you have the wrong mindset, and by wrong I don't mean improper, I mean wrong for adopting covered call writing, then it won't work for you. If you're extremely bullish, it doesn't pay to take a limit, except a limit on the price of your potential profit. And if you love bull markets, don't know when they're coming, but want to make a lot of money when they come, it's not a good idea to be accepting limits on your profit potential. And if you don't care about managing risk, which is a very bad trait and practically destroys your ability to make money anyway, but if you're not really interested in managing risk, then covered call writing probably doesn't pay, because you can give yourself a chance to go for the big bonanza and ignore risk. So covered call writing is not for everyone. Typically the trade looks like this. You buy a stock at a price somewhere around here, and you collect a cash premium which lowers your cost basis down to the black line. And if the stock moves higher, you have an ever increasing profit, ever increasing until, and we're referring to expiration date, until the stock reaches and exceeds the strike price. Once we're past the strike price, the stock will continue to rise, but your profits are limited. You sold all price accumulation above the strike price when you sold the call option. Now remember, you were paid a premium for this, so you got cash to limit your profit potential. I mean, it was a fair deal at the time you made it, and sometimes the people who buy the options have to win, and you have to earn less money than you might have earned. We have to have times when the stock rallies, and you can't feel bad about it. You shouldn't feel bad about it. It's part of the game. It's part of writing covered calls. And when the stock declines from here to here, you still have a small profit. It's only when it declines by more than the premium you collected that you're in the red and have a loss. Now this loss continues all the way until the stock hits zero, so you can lose a substantial sum anytime you own stock. That's not true of this strategy, it's just true of any time you own stock. Here's an example. I chose a stock for which I have great respect. OFRP. It trades at $57 per share. We're going to buy 100 shares and sell one call option. In this case, we're selling the July 15, 2011 60 call. What this means is, that's the stock symbol. The option expires July 15, 2011. Strike price is 60, and it's a call. Expiration Friday is always the third Friday of the month. So that is where the date comes from. In recent times, the exchanges have added weeklies options. So for the most actively traded stocks, options also expire on the first, second, and fourth Friday, and even the fifth Friday if there is one. So in those cases, you have to be very careful to put down which specific expiration you're talking about, because when you communicate with your broker, either verbally or electronically, you want to be sure that you buy or sell the option with the correct expiration. So if you learn to use the longer nomenclature here with the date, the month, the day, and the year, it'll make it easier for you. But it's not necessary. You can call this the July 60 call if you want to, as long as there are no other expiration dates in July. We always used to call it the July 60 call, but now things are different with those weeklies. If you sell this option under the conditions described later, you will get $175 or $1.75 per share. That's the premium that the buyer of this option pays to you, the seller. What that means is you paid $5,700 for stock, you collected $175, so your net cost is $55.25. If you want to call that your basis or keep your books in some manner that illustrates this number, that's fine. You don't have to. A lot of people prefer to just keep their record showing that they paid $57 and collected $175. How you keep your books doesn't matter. I would just suggest you have some method for keeping records so you can track what you've done and what's worked for you and what hasn't. But there's no need to do it any specific way. So you wrote this covered call. Now what? Well, let's assume that you've waited all the way to expiration, you haven't touched the position, and the option finishes in the money. That means OFRP is above $60 per share. Because the option is in the money, it has value. The call owner will exercise, and the person who wrote the call, that's you, is assigned an exercise notice. And all that means is you have been told that this call has been exercised and you are now obligated to sell your stock. So you sell your stock and you collect $6,000 in cash, goes into your account. The $175 you received for selling the option, that's already in your account. You received that earlier. So the net effect of this is you sold your stock at the strike price, which is $60, and you have a $475 profit. And there's two ways to look at that, or two ways to determine this. First of all is you paid $55.25 and sold it at $60, so that's a $475 profit. The other way to look at it is that you paid $57 for the stock and sold it at $60, so that's a $300 profit, but you get to keep the option premium, which was $175, so you add that to the $300 and come out with the same $475 gain before commissions. Now that's 8.6% in 7 weeks, and that's a very good return. Excellent result. What happens now is you have the $6,000 that you were given for selling the stock, and it's yours to hold or invest. Do what you want with it. If you're a confirmed covered call writer, you'll find something to invest it in and write another covered call. Otherwise, it's yours to save until you find an appropriate investment to make. For the sake of safety, I want to repeat some terminology because we certainly don't want to go on too far without being sure you understand these simple terms. Exercise. That's what happens when the option owner chooses to do what the contract allows him to do. In this case, it's a call option, so he has the right to buy your stock at the strike price. If that happens, you are obligated to sell. That's an exercise. When an exercise is made, someone who is short that option is selected randomly to receive an assignment notice. That's just notification that the owner has exercised and your account has been chosen to honor that option, and you make delivery. In this case, you sell your stock at the strike price. In this last example, the stock rallied to 60 or higher, and the option was in the money. Again, we're back to your mindset. Let's say the stock rises to $65 or $70. If you believe that selling stock at 60 just isn't good enough, and oh darn, you should have still held this and waited for 65 or 70, or if you'd be upset to see the stock trading at 70 when you sold it at 60, or if you need the chance to earn unlimited profits, then covered call writing is not for you. As I mentioned earlier, it's just not for you. But that's okay, nothing to be concerned with. There is a trade-off here. You get the premium now and you get to keep it. And that's true whether the stock moves higher or lower or it's eventually exercised or not. But in return for getting that premium now, you give away all price appreciation above the strike price. I think that's a good trade-off. I like that, but not everybody does. Now, what happens if the option is out of the money when expiration arrives? Remember, we're still talking about 100 shares of OFRP where we sold one July 60 call. July expiration arrives and the stock is under 60. Well, the call expires worthless. The option owner is not going to exercise when he or she can go out and buy stock in the open market for less than $60. So they're not going to pay you $60. The call expires worthless and you still own the stock. You have a profit if the stock is above your cost basis, the price you paid less the option premium collected. All we know about it is that the stock is under 60 and it may or may not be above this price, but if it's above this price, you have a profit. Rookies hope for this result. That is, they want the option to expire worthless. There's a feel-good feeling about selling an option and having it go out worthless, and gee, you made a great trade. You get to keep every penny, you don't have to give any of it back, and it just feels good. But that's a foolish hope because it doesn't offer the best monetary result. And we'll talk about that again in a minute. What do? Well, you still have the stock, so you can sell it, you can keep it, or you may decide to write another call option. You can choose any expiration. July is over, but you can do August, September, October, whatever's available. You can choose one and do this again. And that's what most people who like covered calls do. They keep selling them more calls, one at a time. Now, sometimes the option will finish exactly at the money. It will finish exactly at 60. And we don't have to analyze the possibilities because there's really only two of them. Either the call will expire worthless, and that's the most likely scenario, or the option owner may choose to exercise and you may get assigned an exercise notice. You won't know till you're notified, and that official notification is available Sunday. I don't know any broker who doesn't make it available Sunday when you have online access to your account, but in any case, you must be informed by Monday prior to the opening of the market. And you can tell by looking at your account. You'll either have cash, $6,000, or you'll have 100 shares of the stock. You won't have both. So they either bought your stock or they didn't. And some companies will send you an email too, but I can't get into that because I don't know which ones do and which ones don't. So if you're not assigned and the stock is 60 and the option expires worthless, this is the best possible result. You not only have your account valued at $6,000, which is the most you could ever have it worth when you've written the covered call with a strike price of 60, and you save some commissions at the end. This is much better than having the stock expire at 59 or 58. Even if you're assigned an exercise notice and don't have your stock, you've made more money. The point is, being assigned an exercise notice is not a bad thing, it's a good thing. Now, all of the results here look good. If your option expired worthless, then you're better off by that $175 in this case premium that you collected compared with anyone who held the stock and didn't sell the call. You're $175 better off. There's a trap in believing that this is easy money. There's a trap in believing that, oh, well, I can always sell calls again and again and again, and I can always keep taking in money month after month. Well, sometimes stocks fall, and when they fall, the premium that you collected may look pretty small compared to the loss you're going to take in the amount that the stock declines. There are risks in addition to the stock falling, and we'll discuss those later, not today, in another session. This strategy is not without risk. But the bottom line, this may not be without risk, but it is less risky. Notice, this is not riskless. It is less risky than owning stocks because you have a cushion. The premium you collected makes all losses smaller for the call writer than it does for just the person who owns stock outright. You earn profits more frequently. You can even earn a small profit when the stock declines. However, profits are limited, and so it's a trade-off. Rookies become aware of the covered call strategy early in their education. I like to bring it up early, but other traders and other brokerage firms discuss this strategy because it's common and used by a lot of people. So new traders hear about it and they believe that it looks like almost free money. And I know it sounds very attractive. I remember how great I thought it sounded. But what they do is they jump right in with no thought. You can't do that. Think it through, make sure it's right for you, trade small, paper trade it even. Don't just jump in and say this is fantastic, the best thing you've ever heard. It's not the best thing you've ever heard. We'll show you better things later on. Just please don't allow this to happen to you. I know you may be excited and anxious to get started trading, and if you have to, and if you own some stock and want to sell one call for each 100 shares you own, that's fine. You know that you're adopting one strategy right now, but don't run out, buy stock just to sell calls. I wouldn't do that. Go through the course, think about your alternatives, and give yourself time to learn more about covered call writing, because we're not going to finish our discussion today. Now, there are valid reasons for writing covered calls, but free money is not one of them, and profits are not guaranteed. I just want to emphasize risk management. Learn now, trade later. That's one of my mantras. Choosing the option to write. There are choices to be made. There are multiple strike prices. Some of the options are in the money, out of the money, and sometimes there are at the money options. Obviously, if a stock is 57, neither the 55 nor 60 is at the money, so not all stocks have at the money options. But they always have in the money and out of the money. And besides those, there are at least 4 different expiration months. So we have these in the money, at the money, and out of the money options occurring in each of the 4 expiration months. And sometimes the stocks also have leaps options, which are longer term. I'm not going to be discussing them when discussing covered calls. I don't believe that they make good covered call writing candidates, and there's nothing major different about them except they're options with longer lifetimes. The one thing I want to emphasize is I'm not going to be able to tell you, sell this call, this is the best, this gives you the best return, and we'll make the most money over the long term by doing this. There is no best strategy, but there is a best strategy for you. Your risk profile, your objectives when investing, how much you want to make, how much risk you want to take, and all of these things together define how you should be trading with part of your money, all of your money. Again, these are your decisions, but I'll help you discover what's a really good strategy that works for you. Here's an example of what data looks like when it's presented. We're looking at this stock, option for rookies premium, priced at $57 per year. And this is a table of the available call options using the average of the bid and ask prices. I did that for a specific reason. I'd rather look at one number, like the 715, rather than the bid and an ask. I'd rather you see fewer numbers right now so that it's easier to see what's going on. And I left these columns blank, and we'll fill them in later. I'd like you to be able to concentrate better on a small number of numbers. I randomly decided that June expiration is 21 days from today, and I used an options calculator to determine these values. 21 days from today is 3 weeks, and expiration is on the 3rd Friday of the month. The estimated volatility is 35. How we got that is not easy to explain, and since this is a fictional trade situation, it doesn't matter. But either the trader makes a real estimate for what he thinks the volatility is, or there's a way to see what the crowd, the trading crowd, or all the computers who are involved trading the options, what they are using as a volatility in their calculations. That may sound confusing, but we as traders can read what they're using as their volatility estimate, at least on average, and we can choose to use the same. And so that's basically where I would have gotten this from in the real world. I would have found a term I'm going to mention now, and we'll get to it again in the future: implied volatility. The implied volatility is 35, and that's what we chose to calculate our option prices. So the June, these are the Junes, and the strike prices are read down. And it's standard format that the lower strike price is on top and the higher strike price is at the bottom. In fact, the highest strike price is at top. If there were 75s or 80s or 85s, you'd see them here, unless you specifically told your computer to only print out part of the available options and not all of them. The market on this might be $7 bid, $7.30 offered, with a mid price of $7.15. And that's what I'm using here. These are all midpoints. One broker calls them marks. if you hear a term you don't know, you should ask what it means, because not everyone refers to these the same, which is really a shame. One thing that options is lacking is uniformity in nomenclature and terminology. Okay, so this could be 710 bid, 720 offered, but the point is we're going to assume that you could buy or sell these at 715 if you wanted to. Notice, as the call strike price goes higher, the value of the call goes down. And although we've mentioned that before, I want to say it again. One of the factors that affects the price of an option is the strike price. If I own the 50 call, I have the right to buy stock at 50. That means I can give up $5,000 and get 100 shares of stock. Well, that's worth more than if I had to give up $5,500 to get 100 shares of stock. And that's worth more than if I had to give up $6,000 to get 100 shares of stock. So I think it's clear that the higher the strike price, calls go down in value. So let's consider buying each of these options in turn. I'm going to do that for all 20 of these. Again, not all today. And we're going to look at why each of these is appropriate for some class of investor, someone who thinks some way, and finding the one that's appropriate for you, that's the challenge. You may be able to figure that out right away just on comfort. Otherwise, if you adopt this strategy, you'll make a reasonable choice. You'll see how it feels. If you felt comfortable, well, you'll make a similar choice the next time. At some point in time, you may think, no, I'd rather try to make more money, or I'd rather try to have a less risky trade, or who knows what characteristic you may decide. But you will find your comfort zone in exactly which types of options that you want to trade when writing covered calls. And although we're looking at 5 times 4, 20 different options here, in reality, when you're ready to make a trade, you'll get it. You'll be only looking at 3 or 4. You'll know pretty much what you want to do before you do the analysis. So let's consider selling the June 50 call. It's an in-the-money call. Now, often, when I even suggest this possibility, I get the question, I just bought 100 shares at 57. Why in the world would I sell it at 50? That's nuts. Well, it doesn't work quite that way, because you're not exactly, although you are selling it at 50, when assigned an exercise notice, you will get $5,000, but you get $715 now. So your total selling price is that $5,000 that you get later, and this which you get now, for a total of $5,715. Now that's only a $15 profit. There may be a few people who would be interested in making this trade, but a $15 profit, especially when it involves buy stock and sell option commissions, and then another commission at the end when you're assigned an exercise notice, this doesn't pay. So I can't imagine that anyone would sell the June 50 call for $715. But as you will see when we look at the later months, there's enough time premium in those that it might be reasonable for some people to sell the 57 call, but we're not selling the June 50 call. The June 55 call has the same thing. If we sell one of these, we collect $305, $3.05 per share. And by the same thing, I mean we're buying stock at 57 and selling it out at 55. An immediate $2 loss. Well, but it's not immediate. We're not selling it at 55 right now. And our net sale price really is the $5,500 we'll receive later, the $305 we receive now. That's $5,805. We have to remember that although we're selling the stock at 55, our net selling price includes the option premium, and that's a $105 profit compared with the $5,700 we paid, less commissions. I hope everyone can see that. When you are assigned an exercise notice, you will collect the strike price, in this case $5,500, later, and you're collecting the premium now, so you add them together and you get the net sale price. I like to define protection as the amount the stock can decline before you start losing money. In this case, we sold the option for $3.05. So if we take our selling price, our purchase price of $57 and subtract $3.05, we get $53.95. $53.95. That's our break-even point. So if the stock declines as much as $3.05, we're still not losing any money. We have our stock at 57, and what we will have lost what we collected in premium, or less than we collected in premium, so we still have zero or a small profit. And that's the protection. I call it downside protection. The point of this is writing covered calls is somewhat safer than owning stock outright, because you gain some downside protection by collecting a premium. But it's a $5,700 investment and your premium is only $300, and so that's a decent sounding protection. But if the stock drops 10 points, you've lost 7. So it's protection, but it's limited protection. Next, we have the June 60 call. We can get $80 or 80 cents per share by selling a June 60 call. This time the option is out of the money, that is, the strike price is above 60. So we're agreeing to sell the stock at 60 if it rises that high. And I know that feels better. Gee, I'd rather sell the stock at 60 than 55. But you have to look at the numbers, because how this feels isn't how you make your strategic determinations. If the stock does rise above 60, you will sell it at 60, and you will make $300 because you paid 57. You also keep the $80 that you collected up front. So you have a $380 profit, and that's good. That's much better than the maximum profit on the other trade, which was $105. So you have much more to make on the upside. On the other hand, you only have $80 of protection. So if the stock falls below 56.20, you're going to lose money. And that's the deal. It's the trade-off. Do you want the chance to make the bigger profit if the stock rises all the way to the strike price, or even part way to the strike price? Or do you prefer the larger protection of $305 rather than $80? There's no right answer. It's which is more comfortable for you. And if you really can't decide, you could do some of each. I've never seen anyone do some of each, but I actually think it's a good idea. It also gives you a chance to mentally think about, it's one thing to analyze a position, it's another when you've got it and it either makes you nervous or it makes you exhilarated or you're totally blasé, which is great. If you can be totally blasé with your investments, that would be wonderful. Controlling emotions is important in this business. But if you have to decide for yourself which feels better. So I'm pointing out to you that you can do either one of these, and one has greater protection, one has greater profit potential. Which is more important to you is the deciding factor. Now the 65 calls are $15. June 65 calls. To me, there's not very much money in $15. I would not sell this. And it's a poor choice for the vast majority of investors and traders. It's unlikely the stock will rise up past 65, but it's possible. Why give up that possibility for only $15? And besides, next week, if the stock has rallied from 57 to maybe 61, then you'll be able to sell this for maybe 40 cents. And at that point, you may decide you want to do it with 2 weeks to expiration. You may decide that $40 is enough. I don't know where you'll think, where your head will be, what you'll be thinking, but $15 right now is not a good idea. However, the very conservative investor who wants to own this stock, who intends to continue to own it, not sell it, and if he is assigned an exercise notice, intends to buy it back, he wants to own this stock. For him or her, you can sell this tiny little option and consider it a dividend. Like I say, this is not for most traders. I would never consider this. But it's not absolutely out of the question that somebody might want to do it. And of course, the 70 call has no bid, and even if you could sell it for a nickel, too little, no profit, and don't forget commissions. This is a bad choice for every investor. No one would sell this call. as a covered call right. In other words, no one would open a new position by selling this call. Someone who bought it earlier and owned it might sell it if he could find a bid, but that's a whole different story. This is not a good candidate for covered call writing. Now, in this front month, we have 5 choices. The 70 is no good at all because there's just no bid, and the 65 and 50 only give us a profit potential of $15. So the realistic choices are between the 55 call and the 60 call. The June 55 call gives you decent downside protection, 3 points, higher probability of not losing any money on this trade. You'll have a profit anytime the stock performs down $3.04 or better. In other words, losses up to that, no change, and all profits are profitable. And so that's a high probability of earning money. And you have a modest return. There's nothing really shabby about 1.9% in 3 weeks. 2% a month does let your money double every 3 years if you compound it, and 2% a month may not sound like a lot, but it's 24% without compounding, and that's darn good for the vast majority of traders. There aren't very many people who can make more than that in a year. So this is not a bad return at all. The June 60 call, on the other hand, has better potential for the bullish investor. You actually might be able to sell your stock for $60 and keep the $80 premium. But there's not much protection against loss. So if you're more conservative, you'll go with the 55. If you're not that conservative and bullish, you'll go with the 60. But one is not better than the other. It all depends on you and how you feel. Now, I'm going to be discussing each of the other 15 choices, and we're going to look at for whom they might be appropriate, and you are among those people, because among those choices are options that are attractive to sell. And there are important lessons to be learned there. And this is no time to take shortcuts and just say, well, go look at the table yourself. I'd rather you didn't do that. I mean, it's fine if you look at the table, and there it is. You can come back to the slide and look at the table, but I want to be able to discuss these with you and take a look at them. I mean, for example, the 70 call over here has no value in June, but in December it's $2, and that might actually appeal to some people. I don't know if it will or won't, but $2 is a far cry from zero. So we're going to talk more about covered call writing next time. And there's a good stop for a break, and we'll begin lesson 4 with completing the discussion of covered call writing. I wish you good trading.